The Kremlin wants you to believe that the Russian economy is unbreakable. They point to the booming factories, the low unemployment rate, and the steady supply of oil money. They call it resilience. They call it the Great Pivot. But resilience has a price tag. And the true cost of this so-called stability is found in a single, terrifying number: 21%. 21% is not a GDP growth target. It is not an export margin. It is the shocking, emergency-level key interest rate the Central Bank of Russia has been forced to deploy, an economic sledgehammer meant to stave off an uncontrollable financial disaster. When a central bank, especially one as notoriously cautious and technically brilliant as Russia's, is forced to maintain interest rates at levels last seen during acute panic, it is an admission. An admission that the country's entire economic structure is fundamentally broken. This is the ultimate, forbidden alarm bell, sounded not by the West, but by Moscow's own financial gatekeepers. The truth is simple. The central bank is actively fighting the Kremlin's war economy, and the 21% rate is the weapon of last resort. This is the story of how that one number signals an economic collapse far more insidious than anything Russia has ever faced. When inflation runs wild, a central bank raises the key rate. This makes all borrowing, for businesses, for mortgages, for consumer loans, astronomically expensive. Why? To suck money out of the economy, slow down spending, and crush demand. It's monetary policy's equivalent of a hard brake. The mere existence of a 21% rate, or even the current, still crippling rate near the 17% mark, is a catastrophe fueling this inflation. The Kremlin. The war economy option. The Kremlin. The war economy operates on a simple, destructive principle: flood the system with money and manpower to produce military goods. This massive state spending on salaries for soldiers, contracts for defense plants, and infrastructure projects pours trillions of rubles into the economy. But where are the consumer goods for this cash to chase? They don't exist. Sanctions have blocked imports of modern Western products. Skilled labor is fighting in the war or has fled the country. The civilian sector is shrinking. The result is a simple economic equation. Lots of rubles plus few goods equals hyperinflationary pressure. The central bank, led by Governor Elvira Nabiullina, understands this is a crisis of demand overpowering supply. Their only tool to manage this political mess is the interest rate. So, they deploy the brake, even if it means destroying everything else. They are choosing to paralyze the civilian economy to prevent a complete hyperinflationary meltdown. The official line from Moscow is that the economy is overheating, an inconvenient side effect of rapid growth. The central bank, however, uses far more ominous language. In a landmark speech, Nabiullina warned that the wartime momentum is fading fast, stating the country can no longer rely on the same tools that sustained growth in the first 2 years. She made a specific, devastating point. The Russian economy has been expanding by activating free resources, and those resources are now nearing depletion. What exactly are these free resources that are running on empty? Labor. The unemployment rate is at a historic low, but this is a statistical illusion. Hundreds of thousands of working-age men have been conscripted into the military. Hundreds of thousands more highly skilled professionals, IT specialists, engineers, financiers, have fled the country entirely. The free resource of available, educated human capital is gone, leading to acute labor shortages that are crippling non-military sectors. Industrial capacity. Factories are running nonstop to produce military hardware, with industrial capacity utilization surging past 80%. This is dangerously high. It means there is almost no reserve capacity for new projects, civilian production, or necessary maintenance. The machinery is being run into the ground, a short-term sprint that guarantees long-term exhaustion and expensive failure. Financial reserves. The liquid assets of the National Wealth Fund, the nation's savings account, have been aggressively burned through to cover the widening budget deficit created by massive military spending. This spending is necessary to keep the war boom alive, but it is effectively mortgaging Russia's long-term financial stability. By raising the rate to 21% or maintaining it near 17%, the central bank is signaling that the well is dry. They are trying to force the political decision-makers to realize, you cannot continue to spend like this without destroying the future ability of the nation to finance itself. The overheating is not a sign of prosperity. It is a sign of an engine being run at redline, with no oil, right before it seizes up. The biggest casualty of the high-rate weapon is the civilian economy. The central bank's high interest rate creates a chilling effect on all non-military investment. Think of a local entrepreneur who needs a loan to upgrade his equipment, or a small construction firm trying to build new housing. When the lending rate is 21%, taking out a loan is a financial suicide mission. Investment in future growth stops. Official data confirms this divergence. While the defense sector booms, civilian industries are in decline. Output has dropped across a vast majority of key product categories. This is the structural decay that makes this crisis fundamentally worse than the USSR collapse. The Soviet Union fell apart, creating a chance for a new, private sector to grow. But the high interest rate today is preventing the emergence of a new, competitive civilian economy, freezing it out of existence. Leading Russian economists, including Sberbank CEO German Gref, have publicly sparred with Putin, warning that the country is sliding into technical stagnation. They see the real damage: the shrinking of the available consumer market, the inability to replace foreign technology, and the overwhelming financial dominance of the state. The central bank is using the rate as a desperate tool to cool the system, but the effect is not a slowdown. It is freezing the only part of the economy that can generate sustainable, non-military wealth. The secondary, and arguably most dangerous, alarm the central bank's policy generates is the threat of a systemic banking crisis. When lending rates are high, people and companies still take loans out of necessity, but their ability to pay them back plummets. This is creating a ticking debt bomb in Russia's financial sector. According to analysts at the Kremlin-aligned Center for Macroeconomic Analysis, KMASF, a source that cannot be dismissed as Western propaganda, Russia could face a systemic banking crisis by late 2026. This crisis would be triggered if the share of troubled assets exceeds a critical threshold, or if depositors start pulling their money en masse. The warning signs are already visible. Unsecured consumer loans. The volume of bad loans, those overdue by more than 90 days, has surged dramatically. The quality of unsecured consumer lending, issued at the high interest rates of the last year, is rapidly deteriorating. Corporate debt. In the corporate segment, a vast amount of loans to small and medium-sized businesses have been restructured, effectively masking a growing crisis. Companies facing stagnating demand and crushing interest payments are struggling to stay afloat. The central bank is officially downplaying the risk, claiming banks have enough reserves. But the fact that a Kremlin-aligned think tank is publicly issuing a warning about the need to restructure or nationalize over 10% of banks to prevent fallout tells you the severity of the internal concern. The high interest rate is not just a brake on the economy. It is also accelerating the accumulation of bad debt, making the financial system deeply vulnerable to the next unexpected shock. Beyond the domestic crisis, the high interest rate is an attempt to stabilize a ruble under massive pressure from geopolitical isolation, a situation we call the ruble trap. The problem isn't that Russia can't sell its resources. It's who they sell to and what they get paid in. Russia is now deeply dependent on a handful of buyers, mainly China and India, who can negotiate massive discounts on oil and gas. Even worse, the payments are increasingly being made in non-Western currencies like the Chinese yuan or the Indian rupee. For Russia, this is a financial nightmare. Loss of hard currency. The proportion of exports paid in hard Western currencies, dollars, euros, has plummeted, shrinking the pool of money Russia needs to buy advanced Western technology, even via complex gray markets. The currency conversion problem. Russia now holds massive amounts of yuan and rupee that are not freely convertible into the goods it desperately needs. They have the money, but they can't effectively spend it on foreign goods and technology, trapping their wealth in foreign bank accounts. The high interest rate is one of the central bank's few remaining tools to incentivize foreign currency holders not to rush their money out of the country and to shore up the ruble's artificial valuation. It's a desperate measure to manage the outflow of capital and the inflow of useless currency, reinforcing Russia's position as a technologically dependent junior economic vassal of its new trading partners. When the Soviet Union collapsed, the economic disaster was a sudden, violent event. The current Russian crisis is something entirely different. It is a slow-motion collapse where the economy does not die in a single spectacular crash, but is slowly, systematically, and structurally dismantled from the inside out. The 21% interest rate is the ultimate symbol of this process. It is the Kremlin's desperate attempt to win a short-term military victory by sacrificing its entire long-term economic future. It is a sign that Russia's own financial regulator knows the foundation is rotten. The alarm has been sounded. The free resources are exhausted. The technological doors are sealed. The financial time bomb is ticking, and the interest rate is the pin that has been pulled, guaranteeing that when the dust settles, Russia will be poorer, technologically obsolete, and completely reliant on the mercy of others. The sanctions on Russia were meant to cripple its energy exports, yet somehow, the money is still flowing. But where is it really going? Next week, we trace the hidden financial pipelines Russia is using to bypass sanctions, the shadowy network of middlemen, tanker fleets, and foreign banks keeping the Kremlin funded. Click on the video on your screen right now to uncover the full story of the sanctions black market and how it's changing the balance of global power. And if you want more deep dive analysis like this, smash that like button and let us know in the comments. Do you think the central bank can keep the economy from collapsing, or is it already too late? Subscribe so you don't miss our next video.